Good afternoon and welcome to all of our participants in our regularly scheduled Thursday afternoon webinar. We have a real interesting webinar today. Its format's going to be a little bit different, but before I go into that format, let's just revisit the Zoom portal. And it's really important today to look and find that Q&A portal, because our ability to have a robust conversation today is really going to depend on you. And I really encourage all of you participants to use the Q&A portal and to key in questions and chat with us throughout today's webinar. So today you'll have just the three of us, Steve, Terry, and myself, and we're having a very interesting discussion today on businesses and some of the impact of where we are now with COVID and specifics around sellability of businesses. With that said, Steve, I'm going to give it to you and let you go ahead and set the stage, and then we'll jump in and start to have a conversation.
Beautiful. Thank you, Marquita. And as always, we're very appreciative of you giving us your Thursday afternoons to moderate these panels. So thank you once again. Folks, this week, a little bit different. We're going to talk for just a second about COVID aid. There appears to be movement on Capitol Hill, which is kind of a nice thing. And then we're going to jump right into, can I sell or buy a business in this environment? We're getting a huge amount of questions and activities around that. Subtitled to that is, probably as a business owner, you may be ready, but is the business ready? And most likely, maybe not. So we'll have some discussion about that, and I think you'll find we've got a couple of things that we've got to share, and hopefully that'll be productive for you as a listener. So first and foremost, Congress is back engaged in the discussion. That's a nice thing. So Secretary Mnuchin and Speaker of the House Nancy Pelosi have been engaged in discussion, and then there appears to be a strong contingent of Democrats that want to make a deal. So lots of things happening again, and again, as it relates to the Paycheck Protection Program, the PPP, I would encourage you, if you haven't been in contact with your lender recently, get in contact with your lender, confirm that what their process will be for the forgiveness application. I think, as our audience is well aware, there's the long form and the short form. If you received a PPP loan of less than $150,000, you can probably use the short form. If you received a loan that was larger, you're going to have to use the longer form. But many of the banks, and certainly all the banks that I've talked with, and Marquita and Terry, I'll rely on you to jump in if you've heard otherwise, but all the banks I've talked with have said, hold off on making your forgiveness application based on the fact that there is pending legislation that would impact that. And the impact is that the legislation seems to have provisions in there that there may be blanket forgiveness coming for many businesses, particularly those that have received loans of $150,000 or less. So if you haven't applied yet, talk to your bank, understand what your bank or lender is doing in that regard specifically, and then make plans accordingly. So with that, let's dive right in. So we, as a business, we help people buy and sell businesses. We help people value businesses. We teach business owners what valuation consists of and how to grow value of their business over time. And then we also teach business owners through our coaching programs how to increase the value of their company, and even more importantly for them and their family, how to improve the profitability of their company today and into the future. So we've got a lot of programs in that regard. Our inquiry level has ramped up dramatically over the last few weeks, and it's from both buyers and sellers. Just this week, we've got the quarterly market pulse report that came out to us as members of the International Business Brokerage Association. We get this report every quarter. It helps us keep our finger on the pulse of exactly what's happening throughout the industry, and it's a real nice survey of general trends that are happening in business brokerage and business valuation. So a couple of interesting changes, and we thought we'd bring those up. So first question is, why are people out there interested in buying and selling businesses today? Well, from a selling perspective, there are 5 main reasons, and you can see them on your screen. Over almost a half of respondents are citing retirement. And Terry, I know we've had a lot of people say, hey, I don't even want to go through this again. So
yeah, so that's been a real interesting thing of, our business was affected by this COVID-19 financial crisis also, in that it got really quiet from like March to July because nobody wanted to buy a business, right? And but wow, since July 1st, as you know, the number of valuations that we're doing has just exploded. And I really think it's that aging baby boomer population that said, you know what, I don't want to go through this again. And Marquita, it was funny, you jumped on the just for you guys listening, we get on about 15 minutes to half an hour early just to talk about what we're going to talk about. And Steve and I talked about that, that's the situation, that these baby boomers are just like, I'm not going through this again. And Marquita jumped on and said the exact same thing. So it's very interesting. And it's, all of a sudden our activity is really spiked. And that really is, Steve and I talked about doing this webinar, just the 3 of us, for several weeks, and finally, worked out. But I'm looking forward to he's put together a short PowerPoint presentation, and we've got several points that we laid out, but to talk about. So that's where we can go a multitude of avenues. But right now is the time to think about, are you ready to sell, but is your business not ready to sell? Right, Steve?
absolutely.
And I know you're going to go to the other side of it too, but it's both, are you ready to sell or are you ready to buy? Because it's kind of the yin and yang of the market right now, depending on the market or the industry, the sector, and what's going on. You may want to be a net buyer versus a net seller. And Steve, go ahead. I know you're going to talk more about this.
Yeah, so on the selling side, most of these reasons are very familiar to us. I mean, these have been constants for the last few to several years, I'd say, particularly the retirement thing. Retirement has kind of grown its way up the list, and to where almost half of sellers are citing retirement as a primary reason. That's due to demographics, right? The baby boomers are aging up, and as Terry said, they just don't want to go through these big swings anymore. New opportunities has kind of climbed the list a little bit, and we've seen that. We've seen people that are in the hospitality field that have basically been sitting on the sideline. They'd like to get out of hospitality now, get out of retail, and get out of some of the segments that are kind of waning, and really, put their money to work in other areas. Family issues has always been on the list. Unsolicited offers, I think more and more private equity and private investment firms are out there, and more people are getting kind of mail-in offers, and that's a reason why people are beginning to sell. And then relocation is kind of this new thing, and we had this firsthand. So Terry, I know you had a client that basically came to you and said, yeah, this is one of the reasons we're thinking about it, is we'd like to move to another area.
Yeah, particularly Nashville, Tennessee, Florida, and Texas doesn't have income tax. So
state income tax, yeah.
Yeah, that's a huge thing to think about. If you can relocate 6 months before you sell your business, and possibly avoid a ton of state income tax from the sale of your company. So something to think about.
Yeah. On the other side, buyers. I mean, the number one thing right now is buying a job. People are really, really talking about that. And I think we shouldn't be surprised by that. I mean, there literally have been millions of people that have been laid off. Unemployment stats came out this morning. They continue to get better, which is a real positive sign. So initial claims were down again, and continuing claims were down again. So it is a good sign that people are beginning to get back to work. But buy a job is now the number one reason that people are out there in the market buying businesses. Number 2 is gain an advantage, what's called a horizontal advantage. So this is either buying somebody in your industry, picking up picking up another product or service, or maybe buying a competitor in your industry to take them out of the marketplace, or potentially buying somebody within your industry to get some additional skills and capabilities that companies don't have. So, horizontal advantage is now the number 2. Increasing ROI. Obviously, if you buy somebody within your business, you don't need 2 of a lot of the support functions. So, 1 + 1 can equal more than 2, right? You can take out some costs.
That's why I've been excited about doing this webinar, because, I told you, Steve and Marquita, before the webinar, it's like, I really, and I know we're going to have the opportunity to do this, but to talk about the difference between a strategic valuation and a financial valuation, and why that is vitally important. And just the fact that I think a lot of business owners don't realize that growing through acquisitions is a great way to grow your company. And, we'll get into it a little bit later, but, what is the difference between a financial valuation and a strategic valuation?
And we really think that we're going to see more and more people that are interested in that, because when you think about, 0 interest rates, and if you've got any capital sitting in the sidelines, you got it in banks, you're effectively getting 0 return if you've got your money sitting in a bank, and you can put it into buying up, people within your industry and generate a much more significant return on your invested capital. So increased ROI, I think, will continue to grow as we move forward, because the Federal Reserve has clearly said, they're not going to change interest rates for at least the next 3 years. So we're going to be in this low interest rate environment for a good while. And then the 4th advantage is to gain an advantage vertically. And vertically means that you're acquiring somebody within your industry. You might be acquiring a supplier. You might be acquiring somebody that produces some of the components that go within your product or service. And basically, you gain the advantage by bringing this additional business in-house, and you're able to get the advantage of that product or service, and keep that profitability for yourself rather than paying somebody else. So,
yeah, Steve, I don't think this actually came up today, and I haven't even had a chance offline to talk to you about it yet. We have a client that they rely on a manufacturing company to supply them, so they do not manufacture the product that they sell. Mm-hmm. And there's a possibility that manufacturer is going to go out of business, which is their 25% of that manufacturer's business. And if they go out of business, it could have a very adverse effect. So they've engaged us initially to see about buying that manufacturing place. So there's a lot of scenarios going on right there, and it just depends on, are they healthy through the COVID process, or have they been severely affected that they might be going out, or like you said earlier, just shutting the doors.
Yeah, and boy, would that would put their business at risk too. So they're in a position to buy it. They could probably buy it for pennies on the dollar.
Exactly, and that goes back to my point about talking about a strategic versus financial valuation. That there's some really neat opportunities out there right now.
No doubt about it. So who buys? The next question you might ask yourself is, who buys? Well, if you're thinking about it from a seller's perspective, the sellers really got 3 doors that are available to them. One is they can sell to somebody they know, what we consider an insider. So this could be, sellers can sell to key employees. They could sell to their entire employment base by doing an ESOP. They might sell to a competitor that they know. They might sell to a family member, or they might sell to, someone that is in their circle of influence that they've talked to about their business for many years. So we see that about a little more than 60% of the time, sellers end up selling to somebody that they know, and they may not always know on the front side that person is interested in their business until it becomes apparent that their business is available, and then people tend to raise their hands and say, "Hey, we'd like to talk to you about that." About a third of the time, sellers sell to somebody that's unknown to them. And that's, that's where folks like us bring a lot of value to the table, because we do get a wide audience out there on a confidential basis, and really are able to attract a lot of folks that are unknown to them into the process. And then finally, about 10% of the time, company owners just decide that they don't want to go through the process at all. They just want to close the doors and liquidate.
Yeah.
And sometimes that's due to them. Sometimes it's due to external forces, right, Terry?
Yeah, or that the company's not ready to sell, which is part of the theme of this this thing. It's really sad. We experienced that with a client that came to us last fall, and the owner was overly involved in the company, and in the company was overvalued, unfortunately, and they tried to sell it to a key employee, and it was a crash and burn. It didn't work just because it wasn't a bankable deal, which is something that's really big in our valuations that we talk about, is a bankability method. If I tell you your company is worth $1 million, can you pay yourself a fair salary, make a reasonable down payment, and have the cash flow to pay for that company in 5 years? So the company was way overvalued, which was sad. And the owner dug his heels in on that value, and the key employee couldn't find a bank to support it because it was unbankable. He ended up quitting. And now you have a situation where the owner is the only employee, and nobody will buy it because of the owner's over involvement in the company. And that's a sad situation. And they ended up closing their doors and getting no value for the company at all.
Yeah, and part of it was that owner was to the point where they really wanted to retire, and they just didn't want to put the time and effort to make it sellable.
In his late 60s and having health issues.
Yeah, that's a sad situation.
Literally left in the high 6 figures on the table because they didn't set up the sale of the company correctly.
Yeah, shame. Well, the other thing I think it's important to understand is that there are at least 2 primary buyer types, and we break this down to different levels depending upon the company that we're working with as well. But there are strategic buyers and there are financial buyers, and it's key to really understand, are you dealing with somebody who is evaluating your business from a solely financial perspective, or are they evaluating it from a strategic perspective? And the reason that's really important to sellers is because strategic buyers are typically willing to pay more because the value to them is much greater. And financial buyers are typically only willing to pay a finite amount because they're making a decision based on the financial parameters of the particular business. So fortunately, there's slightly more strategic buyers in the marketplace than there are financial buyers. But it is important to really understand, when you're in the process of considering selling your business, are you going to target it towards financial buyers, or are you going to target it towards strategic buyers? Because the approaches are going to be a little different in that regard as well.
Yeah. So, wow, this is a cool spot to jump in. I think it's very important for those of you listening to understand the difference between a financial and a strategic valuation. So, we do a lot of business valuations, and when we value a business, we are predominantly valuing the current cash flow of the business. And if you're reading, to give a cheap plug for the book,
read the book.
No, read the book. My accountant and I always butted heads about this. He said, Terry, you pay for a company for the cash flow that is currently spinning off. But I would always argue with him. It's like, yeah, but if we buy this company, we're going to eliminate all these expenses and it is worth this. But no, but primarily when you buy a company, and this is where it gets important. Primarily when you buy a company, you are paying for the cash flow of that company. Now, in a strategic acquisition, back to my oil company days, if I buy another oil company, I'm going to eliminate a lot of the operating expenses that they have. So think of I don't need to hire, I'm not going to pay the accounting fees that they pay because I already have an accountant. I'm not going to pay the insurance fees that they pay because I already pay all the insurance. A lot of those operating expenses are going to go away, especially if they're in the geographical area that you already cover. I mean, you may eliminate 50 to 60% of their operating expenses, which increases the cash flow of that company for you. So from a strategic standpoint, that company could have a much higher value than what is expected, from the seller, from their financial perspective. So that is a really, really, really key thing to think about and to consider on how to grow your company through acquisitions. So
And it's not just the reduction of cost. You might add a different line on.
yeah,
You might take a competitor out of the marketplace and now put yourself in a controlling monopoly position of, controlling the customers in a market.
lower your cost of goods sold because you have a better buying power. I mean, yeah, there's several reasons. So it happened this spring before the whole COVID thing happened, and me from buying 11 other oil companies and growing my company like this. I had a potential buyer of a company that told me, why would I want to buy that company? It's 100% in the geographical territory that I already cover. That's ridiculous. And oh my God, I about jumped out of my chair. And I'm like, why wouldn't you buy it? Because one, you don't know who all of his customers are. And if you pay him a fair price for his company, and he goes around and tells his customers, hey, Steve bought my business. He paid me a fair price for the business. Work with him. You could gain 90% of those customers, and they'll be sticky. They'll stay with you because the previous owner told them to, who they trust. So, I mean, it's a perfect situation. And, it worked out really well for me in several occasions.
And you know what, Terry, I'll pile on top of what you do because you're aware, because you're a value builder consultant too, that one of the things we take a look at in the process of the value in value builder is what is the cost of acquiring a customer. And when you think about how do I grow my business, do I grow through acquisition or do I grow de novo by going out and trying to earn those customers one at a time through a marketing campaign? And as you get into your business and you take a close look at the cost of acquiring a company, there may be some really prime opportunities to buy a book of customers at a rate much less than the cost of the marketing to acquire incremental customers in your business. And that's a really key point to look at.
It really is. I mean, you're increasing, especially, I mean, there's just so many reasons to buy to buy a company within what you're already doing. I mean, is it going to increase your geographical area? Is it going to increase your market share in a specific area? Is it going to give you another line? So think about this. And I mean, this is really important. So say you got an existing customer base, and look at Steve's pie chart that's up there. Say in the orange, or you're in the blue. I'm looking underneath succession, and those are all your customers. And if you buy the gray area, which might be a much smaller competitor, but he offers a product that you're not currently selling, and all of a sudden you get to sell it to everybody in your blue. I mean, bam, that's powerful.
And yes, Terry, we know we can buy it for pennies on the dollar because he's liquidated. This is the one who was deciding to liquidate anyway. So there's always a deal to be made there.
Yeah, and I mean, that is really powerful. And from a business standpoint, it's really something that needs to be considered.
Without question. And, I think the other side of that is pricing. When we do valuations for companies, it's very common that we see that companies do not change the price to their customers on a regular recurring basis, right? And, the significance of that is if you're in a marketplace where you grow by stealing customers from a competitor, very often people are companies are leading with price as the lure to get customers to cross the street and do business with them, right? So now if you buy your customer's book of business, you buy all of their customers, you may have pricing authority in a marketplace. So it might put you in a position where you can begin to raise price on a regular recurring basis because you just don't have many customers out there or many competitors out there anymore. And it can have a very dramatic effect on increasing the value and net worth of your own company as a result. Maybe even more than what you paid to achieve those additional customers by acquiring the competitor.
Well, we're all sounding like we're very bullish on buying right now, not so much on the sell side.
Well, so yeah, so Marquita, you've had some challenging experiences on selling companies as we have all. So let's talk about the flip side of that a little bit.
Yeah.
And some of the things that I had written down before a meeting that we talked about is one that I think is first and foremost is IRS Revenue Ruling 59-60. And I point this out in every valuation that we do. And it's almost kind of funny, to be honest with you, because IRS Revenue Ruling 59-60 says your company is worth what you're willing to sell it for and what somebody else is willing to pay for it, giving all relevant facts. So it is kind of ironic. It's like, okay, you paid me to do a valuation, but here's this IRS Revenue Ruling 59-60. So no matter what I tell you, your company's worth what you're willing to sell it for and what somebody else is willing to pay for it. So, that at the end of the day is what your company is worth. But there's several things that lead into, wow, what makes a company sellable and what makes it unsellable. So, Steve, you can probably jump into that with your graph.
Yeah, so we always say this is the picture of the most highly desirable business, regardless of industry. So if a business has got revenues that increase over time, with gross profits that grow faster than the revenues and net income that grow faster than the revenues over time, everybody wants to buy a business like that. When we talk to buyers, that's the picture they paint us. And when we see this from a seller's perspective, now we know that this is probably the most valuable business in that particular industrial classification, because this is a pretty rare bird. This is not indicative of what happens with most business owners. And this is the core of what we teach business owners. When somebody comes to us and says, look, I want to sell my business and I don't really need to exit right this minute, but I want to get the maximum value for my business and I want to get everything I can out of it. We put them on a path over the course of a couple of years where they create this picture within their business. And when they do that, as you said, Terry, valuation is kind of on a continuum, right? You can pay a low level evaluation, you can pay a high level evaluation. And if you want to achieve that high number, this is the picture of your business that you got to paint out there. Yeah, we've proven this over and over again.
Yeah, we have a question, and it's a very relevant question. So Eric asked, sellers frequently protect the fact that they are considering the sale of their company. Can you offer insights for both buyers and sellers? I got to laugh at that, Eric, because that's an excellent question, but it is the ultimate conundrum. Mm-hmm. No business owner ever wants to tell anybody that their business is for sale. So I would approach that in two ways. One, confidentiality is absolutely huge. It is paramount to what we do every day. But there is a lot of times, especially with smaller businesses, that I tell people, you know what? The best thing you can do is tell people you want to sell your business. What's the big secret? You want to sell your business, but a lot of times confidentiality is a big thing. And that's why in our coaching program, especially through the value builder system, they call it the envelope test, that we encourage people to think about, who am I eventually going to sell my company to? And pick out some strategic people. So that's from the seller's perspective. So from the buyer side, I would tell you that a lot of the companies that I bought, I called it planting the seed. I would give a competitor a call and say it's Steve Denny and say, Hey, Steve, it's Terry. I know we're competitors, but I just wanted to say hi and introduce myself. And, you know, if we ever have the opportunity to work together, that would be great. And oftentimes the first comment that a Steve will give is, okay, thanks for calling. And that's all you get, right? But then you call him back a year later and you say, hey, Steve, it's Terry Lammers. Just wanted to say hi again. How's everything going? And then the conversation expands. And, you know, and you say, if we ever have a chance to work together, let me know. And then magically, so planting the seed, right? And then magically, all of a sudden one day, you get a phone call from Steve and he's like, hey, Terry, you said you might be willing to work together with me. Can we have coffee? And as simplistic as that is, that's how it works a lot of times. Now, in our business, a lot of times, I mean, people will very actively, you know, just send out letters randomly, and it does pique people's interest. So, I mean, there's a number of ways to go through it. But if you're a local person and looking to grow your business in, you know, a core area, don't be afraid to reach out to your competitor.
Yeah.
Right,
Terry, I'd like to add on to that too, because one of the things from a seller's perspective is you think of why the seller wants confidentiality, and more often than not, they're trying to protect some core component of their business. It's protecting their employee base. If say they are an employer, they don't want their employees to become skittish around the fact that the business might sell. It creates uncertainty. If they're key vendors, they don't want to take a risk with the vendors around that. Or clients, they may not want to lose clients because of the possibility that that's going to happen. If a business is smaller and you are pretty much a service business where you deliver the service and you don't have a lot of employees, so there aren't those, if you want to call it, stakeholders or interest groups who are likely to become, if you want to call it, nervous, see the risk in it. I would say in that instance, there is little risk in being forthright about the fact that you're willing to sell your business, because the probability that you're going to lose clients, lose vendors, lose employees is less because you don't have a lot. You know, you may even be a sole practitioner, so it's almost a moot point then. But as you become larger, the confidentiality is huge relative to keeping those people comfortable, working well, providing quality work, providing quality services to your clients, and the clients being confident to buy more and more from you at a point in time. And that's why, you know, in general, people want to be maintain the confidentiality.
It is a huge thing. And I mean, and it does strike on both sides of the fence. It's not only, you know, you don't want to get your customers nervous, but you know, you don't want to get your employees nervous either, because the last thing you want to do is lose a key employee right before the sale of the company. And, you know, that's another thing to talk about from a seller's perspective is, I'll give you a great example. We had a company that we sold, and it was a husband and wife that ran the company, about 20 employees. They had 2 key employees that pretty much ran the company. They could go on vacation for 2 weeks, no problem. Everything ran fine. Well, we found a buyer who was another husband and wife situation. And the buyer was a younger couple. He had a MBA, but he had experience in the company that he was looking at buying, but not a great depth of experience. So he wanted those 2 key employees to stay on. And if they didn't stay on, he wasn't going to buy. Well, there wasn't no golden handcuffs to keep those 2 employees on after the acquisition of the company. So we literally sat in a conference room with his attorneys, with the buyer's attorneys, the seller's attorneys, and myself, discussing how we going to approach this. And there was 2, Marquita, remember this? We was at the Value Builder when I brought this up. So
I remember you took a poll of the audience there.
We was in Las Vegas, and we took a poll of people at the Value Builder Conference and said, here's how we approach this. One scenario was to make the 2 key employees sign a employment agreement with a non-competition clause in it, and they would be compensated a certain amount of money. The other approach was to say, hey, Marquita and Steve, we're buying, Terry's buying the company. We're going to create a profit improvement plan, or a compensation plan, a bonus plan, and great to keep you on board, right? Nothing. So at the Value Builder Conference that Marquita and I was at, I brought it up to the 40 some people there, and like, how would you approach this? What would you do? Would you make them employees sign a contract, or would you just say, hey, everything's ho-hum and we're going to keep on going like we have been? And it was literally a 50-50 split, right, Marquita?
Yes.
So ultimately, what we decided after many dollars being spent on attorneys is we was going to keep it a ho-hum situation, because this was a blue-collar company, and these 2 key employees had never signed an employment agreement. They'd never signed a non-compete clause, and the likelihood of them telling you where to put that agreement, we'll go there, was probably pretty high. So we did go with the, everything's going to be fine. We're going to have a profit sharing plan. It wasn't without its bumps and bruises, but we did get the deal done. But more importantly, if you're a seller, you really need to be thinking about that. It's one thing if you're overly involved in the company, but it's also another thing if you have a key employee that your company is very dependent on it. In Marquita, in the Value Builder system, we call it the Switzerland structure, right? So what we mean by the Switzerland structure is Switzerland is a very independent country. So is your company independent of anyone supplier, anyone customer, or anyone employee? So those are really key things to be thinking about, because that gets into the non-financial things that affect the value or sellability of the company. And it's often the non-financial things that, it's not going to, don't think of it as it lowers the value of your company from $1 million to $800,000. It makes a difference of whether your company's worth $1 million or
unsellable,
completely unsellable. And that is so true. Steve, I'm sure you could point out several situations with that also.
Yeah, a couple of things. I want to make sure we leave the audience with one thing, though. Time and experience will always say that the vast majority of the time, and I would say, there's no statistics, but probably 99% of the time, employees stay. So that they're generally in a transaction. There is very little effect on employees leaving, unless, of course, a new buyer comes in and makes significant changes. If they make significant changes, that's what scares people away. But if they come in and don't make significant changes and basically keep the business running, people tend to stay. We all know that. And the last point I want to leave with you guys is, we're a product of our own home cooking here. Marquita, Terry, and I, we all came together. We were all independent contractors that came together as an entity because we started working together. We got to know each other. We started working together. And eventually it just dawned on us all that, the combination of the 3 of us together would make for a much greater team than each of us out there individually. So.
Yeah, and so to pile on to that, so 2 things I used to always say whenever we was going through a transition. I would preach to my employers and future employees, keep an open mind. So just, if you're going through an acquisition, just tell everybody to keep an open mind. There's going to be changes, but 2, if you're the buyer, don't make a ton of changes right out of the gate. Just go with it for a little bit. And again, cheap plug, read the book.
Read the book.
You've got to earn people's trust. There may be things out there that you want to change and that need to be changed, but just, if you're the buyer, give it a little bit of time, let people earn your trust, and then go from there. So unless
the building's on fire, don't douse it, right?
Yeah, exactly. So to Steve's point, we've recently added, my gosh, like 8 people to our team, added
Yeah.
Julie Humphrey from Link. So, we're experiencing that right now again, which was another thing that I always told my employees is expect change. Things are going to change, and things are changing for us because we just added a whole group. And I'm proud to say that our whole team is up to like 18 people right now, which is incredible. So,
Yeah, it's been a lot of fun. Yeah, grow or die, right?
Yep.
So another huge question is price. What is pricing doing? And one of the key things that we get out of this quarterly Market Pulse survey is this chart. And this chart is, let me explain it for you. So we just completed, we actually just completed Q3, but we get the report basically a quarter in arrears. But at the end of Q2, the multiple of price paid, which is seller's discretionary earnings, so net income in the business plus the owner's compensation plus any add backs that need to take place plus interest, taxes, depreciation, and amortization would equal seller's discretionary earnings. So if the business is producing less than $500,000 in SDE, the survey says that, as you can see, sellers' discretionary earnings from a multiple perspective has been going down. If the business is generating somewhere between $500,000 and $1 million a year in sellers' discretionary earnings, actually the multiple is recovered and has actually gone up over time. And then $1 to $2 million, multiple is holding steady. And then from $2 to $5 million, multiple has been holding steady. And obviously at $5 million and above, multiples down just a touch, but that just may be due to the fact that there typically aren't a lot of transactions that are in that large category. So generally the sample size is a little smaller there. But
I think what's great to point out, Steve, is to look at the multiples. And I think this chart rings very true to how I would do a valuation or sign off on one. If you have a company that has less than $500,000 in seller's discretionary earnings, you're going to get 1 to 2 times earnings. Basically, you're going to be lucky to get 2 to 3 times earnings. In that 5, just look at the general increases as you go down. $500,000 to $1 million in seller's discretionary earnings. So what's seller's discretionary earnings? That is all of the earnings coming into the company that the seller has the discretion of spending, whether you pay yourself a salary with it, whether you're paying a loan, whatever you're doing with it. So
buying your car.
What's that?
Buying a car, right? Paying a car, buying your Cardinals tickets, or you're funding your airplane, or whatever the case may be.
But this chart, I really believe on its face value is very accurate. It really is. So
Terry, I'll add to that too, because I always talk about the cocktail party talk. Obviously in COVID, we're not having cocktail parties, but it's real funny when you go to these networking meetings, if you will, with people in our industry, you start to hear people throwing out these numbers saying, oh, companies are going on average for a 7 multiple. And I always laugh when I hear that, because this chart says it all, and we're only talking about Main Street and lower middle market on this chart. But when we start to hear people talking about 7 multiples, 10 multiples, and even larger 15 multiples, more often than not, they're publicly traded firms or very, very large privately held firms that tend to go for those kinds of multiples. Normally, when we're in the space that we normally work in with Main Street companies and lower middle market companies, it's rare to see the 5-6 multiples in the deals. And Terry, you do more evaluations than I do. What are your thoughts?
Well, my thoughts are I'm about ready to jump out of my chair. So think about it, guys. So here let's go back to, we talked about, is it a strategic valuation or is it a financial valuation? This chart that Steve has up is from a financial valuation perspective. So look at the 3.3 times multiple, and let's just say it's 3. That's 33%. That means you're going to earn, basically it's going to take you 3 years to pay for that company. And if you divide your cash flow by 33%, that's it. So let's say the cash flow of the company is $1 million, but I can wipe out $400,000 of operating expenses because it's a strategic acquisition. I already do what the company's doing, and I can do that. So if you take $1 million divided by 0.33, that means that company has a rough value of $3,030,000. If I can do from a strategic standpoint, and I'm going to eliminate $400,000 worth of operating expenses, so now it has a cash flow of 1.4 million. Divide that by 0.33, and from a strategic standpoint, that company has a value of $4,242,000. That's huge. So, you know, if you can buy the company from a financial perspective and only pay, you know, like I said, cheap plug for the book, only pay for the company for the cash flow that it's spinning off, you're going to pay $3 million for the company. But the true value to you from a strategic standpoint could possibly be $4.2 million. That's huge. And that is a great way to grow your company.
And we do get those kind of valuations. So there are ways to actually achieve that strategic valuation and actually get paid that additional valuation amount, if you will, but you've got to be very intentional about that. So if you know that, you know, it takes, the other thing I think that Terry talks about in his book a lot, and if you're considering selling your company at some point in the future, you know, you gotta think about putting together a team of people to help you make sure that you get the highest and best value for your company, right? And one of those things is having people on that team that are very knowledgeable and experienced in this line of work. And when you've got the right team, you can position your business to be able to get it in front of all the potential strategic acquirers. And that's when you get into a situation like that, then you're able to basically work strategic acquirers off of each other and basically begin to realize some of that strategic value. So rather than selling it for 3.3, you can get much closer to that 4.3. And we've seen and experienced situations where people will pay beyond the strategic value to make sure that they are the ones that are able to walk away with that company at the end of the deal.
Yeah. So, you know, one of the things I want to touch on real quick, and this has never been about selling things with this company, and we're not selling you anything, but I do want to talk about our CEO to CEO program, Chief Everything Officer to Chief Executive Officer. And Steve, let's touch briefly on the importance of having solid financial statements, readable and relevant, the numbers sing to you. Are you a bankable company, and the non-financial things that affect the value or sellability of the company? I'll let you lead on that a little bit, because we're doing remarkable things with companies and helping them.
Yeah, we say first and foremost, if you really want to sell and you want to sell and not leave any money on the table, your business has got to represent three things. It's got to have three key ingredients. Number one, it's got to have relevant and current up-to-date financial documents, and it's got to have the full range of financial documents.
And accrual accounting.
Exactly. So we see this all the time. One of the things that probably takes the most time to bring a company to market is to take their current financial documents and make them concise and readable and relevant to their industry, so that they can clearly speak to a strategic acquirer who's looking for specific ratios and specific operating parameters out of the business. So it's very common for us to have sellers that come to us, and you know, we see this routinely. We just had one that came to us with all their financial documents. They were current and up to date, but their financial documents were prepared to serve the bookkeeper and the accountant. They were not like industry standard financial documents. So we're in a position where we have to work with that seller and their bookkeeper and their accountant and recast their financial documents in a fashion that makes sense to a potential industry acquirer. And that takes time and effort to do that. But when you do that and you can present the financial documents in the appropriate way, then you can really begin to experience some of that strategic value. So first ingredient is, readable, relevant, and current financial documents. You got to make sure those are in place. The second thing you got to have are good business records. So you got to have all of your contracts and all the rest of your business documents have also got to be current and up to date. And you got to read through those and make sure that you're in a position where you can convey the business and that your contracts don't preclude transfers. So, as you go through, those are kind of some of the non-financial parameters of the business. And if you don't do that up front, you might be in a position where you get halfway down the road through due diligence and find out that you can't sell this business, or the buyer finds out that if I buy this business, I may lose a key supplier or some key customers out of the deal because they're just not transferable. So there's a lot of legwork up front to make sure that you've got all of your business documents in order and ready to go, right? And then
the last company that I bought was a property management company, and it may, it makes it more, there may be something that makes it more difficult to sell, but I think we give a cheap plug to our brokerage side, and where Steve and I and Marquitas and a lot of our brokers knowledge comes into play, is there's 100 different ways to sell a company. So we bought this property management company, and originally we was going to do an asset purchase, but there was over 400 contracts for the management of the properties, and as Steve just mentioned, the contracts weren't transferable. So if we did an asset purchase where we're just buying the assets of the company, we literally would have had to renegotiate 400 contracts. So it turned it into a stock purchase, which has its own complications and different things. It's not impossible, but it is a little bit more difficult. But we had to do a stock purchase where we purchase the stock of the company and then we inherit those contracts because those contracts were not transferable. So that's one little key thing that the person that started this property management company 25 years earlier, her attorney didn't bring it up, she didn't bring it up, and now all of a sudden she's ready to transfer the company, and womp, here's this huge problem. So
yeah, and may have scared off. I mean, we've seen the situations where it scares buyers off when they see bumps in the road like that.
With the sale of my company, I had a repackaging agreement with Mobile. It doesn't matter. It's nothing secret, with Mobile Lubricants, to buy bulk mobile oil and repackage it into drums, 5-gallon buckets, etc. That's a repackaging agreement that you have to have with Mobile in order to do that. The company that was buying my company, they didn't really care about that contract because they repackaged their own products. But had the company that was buying my company had to have that repackaging agreement with Mobile, that creates another hurdle, because Mobile don't care if I'm selling my company. They really don't care who's buying my company. So now you got kind of a two-pronged deal. You got to sell Mobile that that you're qualified to do this. So think about that. What kind of contracts do you have with your suppliers or with your customers? Are they transferable if somebody's going to buy your company? Very important, right?
Yep. Yeah, and the final thing is you got to have a price that's reasonable, and we're going to see that in a minute, because we're getting close to time, and I want to make sure we touch on two other things, and then if there are any questions, we want to deal with those as well. But a lot of people also ask us what type of businesses sell, and this is right out of the Pulse report. I thought it was pretty interesting. You can see right now that restaurants always make up a large proportion of the small businesses that sell. That's down a little bit, but it's still pretty significant. So you can see, I think the bottom line from this particular graph is that basically businesses of all types sell. So, you know, it's astounding. One of the things that's so cool about what we get to do is we get to see businesses that do things that you would never dream that somebody would actually pay to have done. It is amazing. Businesses of all types sell, but they got to have good financial records, they got to have good business records, and they got to have a price that's in concert with the marketplace. So to that end, let's get to why businesses don't sell. And this is the most current rationale for why transactions don't happen. And amazingly enough, you know, according to the International Business Brokerage Association, literally only less than 1/3 of businesses where a buyer and seller agree to make a deal, less than 1/3 of them ever close. And it's astounding. Most of them fall apart. Our experience at IBA, a cheap plug for us, our experience at IBA is 9 out of 10 deals that we get involved with, we get closed. So we do a lot of work up front with our buyers and our sellers to make sure that we try and cover, you know, some of these roadblocks and speed bumps early and get them taken care of so that we can get beyond them. But, you know, the big thing, Terry, I mean, valuation gap is the number one reason deals don't get closed.
Don't get me started.
it's you know, it's
undervalued, it will not sell.
gotta go into the market knowing what it's worth, right?
Yes, it is very, very frustrating. And believe me, Steve and I see a lot of valuations done by CVAs, certified valuation analysts, just like myself, that the company's overvalued, and that's why we trademarked the name bankability method. If it's not a bankable deal, you know, and again,
it's hard to get it done.
Yes, but if you jumped back in your slides, the bankability method kind of falls out of play once you get over $1 million a year in cash flow, because then the buyer's really looking at the return on investment, and they're probably going to be able to bring a lot of money to the table, and their debt structure isn't going to revolve around 100% of the cash flow of the company that they're buying. But if you're definitely in that $1 million worth of cash flow and below, most of those buyers are going to be relying on bank financing to purchase the company. So if it's not a bankable deal, it's not going to work. So that is a true, I mean, we literally trademarked the name bankability method, and that's in every one of our valuations with cash flow under $1 million.
Yeah, and it's really, really important. So the other interesting thing here, sellers don't appreciate the fact, and I know, Marquita, you and Terry know this, maybe our audience doesn't. Sellers are typically the least informed about valuation. When we work deals with other business brokers that don't do valuations up front for their clients, sellers are surprised about the valuation of their companies. We always do a valuation with our clients, but buyers always come to the table with a good knowledge of what valuations are within the industry that they're targeting. So we always find that buyers typically are much better equipped to understand what businesses are worth and what the current valuations are. And you know, it puts them at a strategic advantage. And you know, as a seller, you never want to be disadvantaged when you're negotiating to sell your company. Yep. It just doesn't put you in a place to win.
So this has been a fun conversation, Marquita. I know we're at the top of the hour, so we'll let you take over. But you know, for all you guys listening, this is a great conversation, and I was looking forward to this webinar for a long time because I knew there's tons of things to talk about. And really quickly before we leave, I want to give Steve a cheap plug and a congratulations on his book that's literally going to be coming out in the next month. It'll be the second book in the series of You Don't Know What You Don't Know. Mine has a byline of everything you need to know to buy or sell a business. His is a step-by-step guide for getting the most from the sale of your business, which is, I've read it already, and it's a really cool story about 2 real-life examples of one person that sold their business using a broker and one person that did not. So congratulations, Steve, on getting your book out.
Yeah, thank you very much.
Yeah, I'd like to add a congratulations on that too. So I haven't read the book yet, but I have a hot off the press last draft, right? I think it's the last, is it the penultimate or the very last draft? So
It is.
I'll be reading that, and I'm really excited. I'm really excited about this. And again, congratulations, Steve, on this. But let's just wind it up quickly with our normal format, and that is last words. Terry, I'm assuming you already took your last words, or do you want another last word?
My last words is I'm going hunting. So let's get this done. So thank you everybody for attending deer season.
Absolutely.
Okay, Steve, you get the absolute last word. You've got your book up on the screen, and you might tell us a little bit about what you want to share with the audience as we say goodbye on this Thursday afternoon.
So if this raised any questions in your mind and you didn't type them in there, you can reach Marquita, Terry, myself, and any member of our team by going to our website. Our profiles are up there. Our direct email contacts are up there. We're delighted to engage with you. If you'd like to learn more about what's necessary to really achieve the maximum value out of your business, keep in mind every business is going to transition. You're either going to do it, through a planned transition, or you're going to do it kind of haphazardly, and you get the most value by planning it. So we're delighted to engage with you and would be happy to work through process with you to make sure that you do get the most from the sale of your business. Go to our website. Everything's there. All of our connections are there. We'd love to connect with you, and we'll look forward to talking to you again next week.
Great. And I see from the list of participants, I see names I recognize. I'm not going to go through the drill at the back end of this. You're going to get an email. Look for it in the next couple days. And again, we'll see you next week. Bye all. And Terry, catch all those deer. Is it deer now? What are you hunting?
Yeah, and you don't catch a deer, Marquita. You have
No, don't you have a net? How do you do this?
bow and arrow season. Like Robin Hood. I've never jumped out of a tree to catch a deer.
Be safe in the woods, huh?
See you guys.
We'll see you. Bye-bye.
Bye-bye.